As a part of this series of alternative valuation methods, today we're going to take a look at free cash flow valuation, and that includes the free cash flow to the firm and the free cash flow to equity. Some of the specific topics that we're going to look at as part of this series include when to use free cash flow valuation techniques. How do we define those free cash flows? We'll take a look at the calculation of the free cash flow to the firm and the free cash flow to equity using constant growth and inconsistent growth. We'll take a look at alternative measures of calculating the free cash flow, including valuing from reported net income, valuing from operating profits, and valuing from operating cash flows. We'll also take a look at forecasting of the free cash flows, and also how do we accommodate for non-operating assets. We typically use free cash flow valuations when we can't use a simpler method, and the simplest method is the one that we just looked at, the dividend valuation models. If a company doesn't pay dividends, or if the dividends don't reflect the future value creation in the business, it's probably not a good idea to use that method. The easiest alternative, the next alternative, would be to use a free cash flow valuation method. Another reason why we might use free cash flow valuation is that the investor who we're reporting to, their interest is, or may be in actual control of the business rather than just the flow of revenue that would be achieved from investing in this company. The two different methods that we're going to use of free cash flow include free cash flow to the firm and free cash flow to equity. We also describe these as indirect, the cash flow to the firm, and direct methods of measuring the cash flows to equity. Free cash flow to the firm is the cash flow that's available to capital suppliers, the investors and the banks, after all expenses, including income taxes, have been paid. After accounting for reinvestment or investment in new working capital and reinvestment in capital assets that will allow the company to continue in business in the same type of business it's been in the past. Essentially, this is a measure of the operating cash flows minus the working capital and minus some capital reinvestment. The free cash flow to equity is the cash flow that's available to the equity investors after all operating expenses, interest, and principal payments and investments in working capital and capex have been made. Essentially, this accommodates for the deduction of the returns to capital for the debt investors, for minority interests, and for the preferred shareholders. The calculation of the free cash flow to the firm is essentially exactly what we've looked at throughout the previous courses. Essentially, we call it an indirect approach because we start off by estimating the firm value based on the return to all suppliers of capital, to debt, to equity, using the weighted average cost of capital that we learned to calculate in our previous course. The form that we're following essentially uses the multi-period dividend discount model using free cash flow instead of dividends. So essentially we say that from now until infinity we're going to measure the free cash flow to the firm, and we're going to discount it by 1 plus the weighted average cost of capital. And of course, as we approach infinity, as we approach perpetuity, that essentially becomes the value of the free cash flows discounted at a rate of R. The equity value is essentially this firm value minus the market value of the debt. So to simplify things, our free cash flow to the firm starts off with the net income that's available to the common shareholders, and we subtract from that non-cash charges, things that don't involve a movement of cash in or out of the firm, things like depreciation. Well, I'll give you a longer list in just a minute. We're also going to add back the after-tax value of interest, because of course interest creates a tax shield. So if we have $100 in interest expense and we have a 25% tax rate, $100 times 1 minus 0.25 would be $75. We're also going to subtract any investment in fixed capital that would be fixed capital required to continue in the same line of business. And we're also going to subtract from that the net investment in working capital, in new inventories, accounts receivables. When we mention non-cash items, that includes things like depreciation. It's a non-cash item because it doesn't remove any cash from the company. It essentially moves the cash from one part of the accounts to another. Amortization, similar to depreciation, any kind of restructuring expenses or writing back of restructuring expenses, again, doesn't require or doesn't allow for cash to move in or out of the company. It just moves it from one place in the accounts to another. Any kind of losses outside of business activity or gains outside of business activity would also be either subtracted in the case of gains or added back in the case of losses. There may be other things that we see in the accounts that are less usual, like amortization of bond discount and premia, where those have occurred in the sale of new bonds and new financial instruments. Changes in deferred taxes can also be part of that. Provisions for foreign exchange, bad debt, and so on. Those things that are taken out of the accounts could also be added back. Now, this takes us back to that topic that we saw in MBA 521, the measurement of enterprise value. And we essentially said that the business is made up of two parts. It's made up of claims against equity by debt holders, by minorities and preferred. And what is left of the enterprise after that is the common equity that's available to the ordinary shareholder. So we can calculate the free cash flows to the equity shareholder essentially by removing the effects of debt, minorities, and preferreds. So logically, it really doesn't matter whether we start off with the free cash flows to the firm or the free cash flows to equity. The free cash flow to equity essentially is a direct approach to estimating the value of equity. The free cash flow to the firm, an indirect. Either approach should provide the same estimates, everything else being equal, but of course, usually after we say that, we say there are conditions when things aren't equal. If the capital structure is unstable, the free cash flow to the equity is going to be much better. A couple of cases where we'd use the free cash flow to the firm, subtract debt, minorities, and preferred shares, they would be better, especially if the company is highly leveraged and perhaps has negative free cash flows to equity, or if the company's capital structure is changing. And a good example of that is when we have substantial changes in the organization capital structure, including things like a leverage buyout. One of the best examples of a leverage buyout that we have comes from the 1980s or the 1990s, when we had an incredible takeover, an incredible leverage buyout at a company called RJR Nabisco, one of the biggest consumer good products in the company at the time. It was trading on a share price of about $56 a share, largely thought to be significantly undervalued. One of the managers of the company, a Canadian-born fellow who started off at the very bottom of the organization, worked his way up to become the CEO. He essentially went to a private equity firm and said, our company's undervalued. One of the best ways to increase the value would be to take it private. We can fix it up, we'll improve the structure of the company, and then take it back to the market and we'll all get rich. The private equity firm, KKR, or Kohlberg Kravis Roberts, essentially went along with this, and they tried to take the company private, ended up in a bidding war, and eventually the share price was accepted in a competing bid, and they ended up with a whole different group of managers. The CEO got a $50 million buyout and ended up living in a mansion in Florida and complaining about how he was ripped off. But a great story, in fact, such a good story that they made a movie and a book of that particular leverage buyout. It did set the tone for the next couple of decades, because after Nabisco, there have been many large leverage buyouts. One of the most recent, most interesting ones that we've seen was when Michael Dell approached his board of directors with the backing of a private equity firm named Silver Lake, and actually did take Dell private, buying back the company shares for about $25 billion. Since then, the company has been substantially restructured. It's a completely different organization. And while they do have a type of a public listing, they did essentially go public again. They did it indirectly through a very strange set of takeovers. But the original purchase price of $25 billion has turned into a $100 billion valuation on the firm, essentially making Michael Dell a lot richer. But probably more importantly from his perspective, it's allowed him to turn the company from being a manufacturer of computers, especially laptops, into a cloud computing firm, something that his previous board of directors wouldn't allow him to do. I won't go through all of these examples, but you can see there's a mixed message from many of these leveraged buyouts. In many cases, they turned out badly. In fact, the majority of highly leveraged buyouts do end very badly. To take a step back onto our track, we'd say that the value of the free cash flows to equity can be valued using this simplest approach. Essentially here we're just figuring out what the value of our perpetuity, the value of those free cash flows to equity are going to be, taken every year from now until forever, discounted at 1 plus the discount rate. In this case, the discount rate, though, is not the weighted average cost of capital because we're only looking at returns to equity. So for this one, we use the rate of return to equity, not the weighted average cost of capital. So we'll calculate that using CAPM or perhaps a dividend growth model, but R, or in this case, is R sub E. So if we're going to use an example of how this would work, this is how we would calculate the value of a growing perpetuity. The free cash flows to the firm, if we're calculating the firm value, are going to be grossed up to include the value of growth. So it'll be the free cash flows at the end of the period, the free cash flow in period 1. And to get that, we take the free cash flows in the last period, the free cash flows to the firm, for example, last year, times 1 plus G, the expected growth in the earnings. And for the denominator, if we're calculating the firm value, we use R minus G, where R is the weighted average cost of capital. And so that becomes the value of a growing perpetuity. The value of equity, we would use the free cash flows to equity, accounting for things like the cash flows to interest and to minorities and preferred. So we take those free cash flows to equity from the previous period and we'd multiply that plus the growth rate. And in the denominator we have the return to equity and the growth in equity. So an example of how that would work, in this case we'd say we take the free cash flows to equity, gross that up, discount it at the growing perpetuity rate. So if you have a company with $750,000 in returns to equity, if the rate of return on equity is 12% and the growth rate is 5%, our calculation would be 750 times 1 plus G, 5%. That's where we get the 787.5 in the numerator. In the denominator, we have 12% cost of equity minus 5% growth, and that nets out to 7%. So 787 divided by 7% gives us a total equity value of $11,250,000. If the company has 1 million shares outstanding, on a per share value, that would be $11.25. So if we saw that the company had a $10 actual share price and we have the inherent or the expected value of the company $11.25, this looks like it would be a good buying opportunity. It's taking a step back and following the textbook approach, and in this case the textbook that I'm referring to is the Equity Asset Valuation text that we use from the course, one that's provided by the CFA Institute. And following the methodology and the approach that they talk about very specifically, you can follow along in the text as well, you'll see that the free cash flow to the funds using an indirect approach would be, the free cash flow of the firm using the indirect approach would be the net income available to common shareholders, so basically our net income after accounting for the preferred shares. We'd add back non-cash charges, we'd add back the interest expense after tax, we'd subtract the investment in fixed assets that's required to stay in business in the same line of business, and we'd also account for the investment in working capital. depending on whether that number is positive or negative. If it's a positive number, we subtract it. The non-cash charges, as we mentioned earlier, those can be significant in many businesses and requires a certain amount of interpretation. For example, things like bad debt. Bad debt may be written off in one period and written back in the next. So we definitely want to get rid of that as a cash expense. It's not a cash expense. Provision for foreign exchange losses. Anything that impairs capital, like a lawsuit or a patent infringement suit. Any kind of non-cash restructuring charges, essentially a reduction in the balance sheet value of our assets. Deferred tax also may be a very large and a regular part of those non-cash expenses. So to compute the free cash flow from net income, we're going to do that. Add back the interest expenses after the tax shield. We're going to consider any dividends from preferred shares and deduct those to get the net income available to common. Capital expenditures are typically the change in the fixed capital from one period to the next, accounting for the depreciation. But in some cases, we also see that those expenses are going to be done for shares. If we buy another company to increase our business, we can pay cash, and we'll see that accounted for in the capex part. But we might also have to take a look at the shares that have been issued to get the full accounting. Change in the working capital. Well, we can see that the change in the inventory, accounts receivable, net of the accounts payable can be observed in each of those balance sheet items, or we can also see that number quoted in the cash flow statement. So an example of how that would work in this company for 2015, the net income of the firm was $97.52 million. And we use the same firm example over and over again in the next few slides. We have depreciation, so we add back the $45 million in non-cash charges, but net of depreciation. We have the interest expense. In this case, our interest expense after taxes was 10.98. There was no investment in fixed capital. There was an increase in working capital of $56 million, so we subtract the increase in working capital because it's a use of cash, and that gives us the free cash flow to the firm of 97.5. And we do that for the next few years, and we can see there's the values and the trend in the free cash flow to the firm. We can also, as an alternative, work backwards from the operating cash flow that's reported in the cash flow statement. So essentially here we take the cash from operations, so the operating cash flow, and we add back the interest expense after tax, and we subtract from that the investment in the fixed assets. And that gets us back to the free cash flow from operations. So in this example, you can see we had the operating cash flow that we previously reported. And to get back to the free cash flow from operations, we are going to subtract the after-tax interest expense, no fixed capital, to subtract, and that leaves us with the free cash flow to the firm of $108.5 million. We can calculate the free cash flow to equity from the free cash flow to the firm once we've calculated that. So essentially here we take the free cash flow to the firm that we just calculated, we subtract from that the interest expense after tax, and then we add back any increase in borrowing. Essentially, this is the amount that the firm can afford to pay out in dividends, whether it does or it doesn't. And so that becomes the firm the number of interest in calculating the value of the business. So our example here, we have the free cash flow to the firm was 97.5 that we looked at in our very first example. From this, we are going to subtract the return to debt, which is not really of interest to the equity investors. So we subtract the after-tax value of the debt. We add back the value of new debt, and that gives us the free cash flow to equity. We can also find this from EBIT or EBITDA. And if our operating profit from the company after tax, the EBIT after tax was $300 million. We have non-cash charges. That includes 180 million in other non-cash charges and 120 million in depreciation. And that's where they got the 300 from. We had net investment in fixed capital of 400 million and net increase in working capital of 45. So we take the 300, we subtract from that the non-cash expenses, we add back the non-cash expenses, we subtract from that the investment in fixed assets and the investment in working capital, and that's where we get the free cash flow to the firm of 155. Now we could also, if we only had EBITDA information, do pretty much exactly the same. In this case, EBITDA is greater because the 120 million in depreciation is added to the after-tax EBIT. And then add back to that the other non-cash charges and subtract the same numbers for fixed capital and for working capital. And we end up with the same number. Our free cash flow to the firm is still 155 million. Now, because we're usually looking at the prospective value of the firm, we're very interested in knowing about the free cash flow to the firm and the free cash flow to equity. Essentially, we've already done this in MBA 521, where we forecasted the cash flows, essentially using a percentage of sales approach. We can do this applying a constant growth rate to the free cash flow and use a simple one-period constant growth model, or we can do it on a year-to-year basis, as we did in the case studies that we looked at last semester. Here we're looking at the free cash flow to equity, and if we're going to do that, we'll probably start off with a simplifying assumption that the company's capital structure will not change, at least not without a discretionary choice. And so we'll keep the debt ratio constant. In an example like this, we start off by saying that we expect the sales growth during our forecast period is going to grow by 10%. We're going to maintain a profit margin of somewhere between 17 and 14%. Our tax rate will be 40% throughout. Fixed investment will be 33% of our sales, working capital 15% of sales. And so with that information, starting off from a base number of $3 million, this year our sales are going to grow by 10%, so sales will go up to 3.3, and 10% more on top of that, 3.6, 3.9, and so on for the next few years. Our profit margin will be a percentage of sales. So in the first year, 16.67% of $3.3 million. Well, that's where we got how we got our profit forecast. Tax was 40%, so 40% off of 550,000 is where we got the 330,000 from. The 33% fixed assets as a percentage of sales gives us $100 million in fixed assets, use of our cash. Working capital is 15% of the incremental portion, so 15% of 300,000 is where we got the 45,000 subtracted. And subtracting those costs, adding back the changes in the working capital, give us the free cash flow to the firm. And so we can do that for each of those years and figure out what the values are going to be during the horizon or the forecast period. And then add on to that the terminal value to figure out the overall value of the firm. Now, don't forget that the value of the firm includes the free cash flow from the operations, but also we have to add onto that, to get the enterprise value, the non-operating assets. And our non-operating assets include things that are really easy to value, like how much cash do we have in the firm, marketable securities, and other assets that can be valued independently of the cash flow of the firms. Things like land held for development and minority interests. So we value those separately, add those on to the free cash flow values that we have already calculated. So in this term, we've already looked at many things to do with valuation, and we're going to look at some more. But to understand the value of the free cash flows to the firm, the valuation of any cash flows, we find that this is a method that's suitable for any firm, whether it pays dividends or not, but especially suitable for non-dividend paying firms. We can value equity directly using free cash flow to equity, and we can value it indirectly using free cash flows to the firm. free cash flow to equity works best for firms that have not had, or we don't expect to have, any substantial changes in their financial structure or highly leveraged. Free cash flow to the firm works for any business, but the valuation of things like the tax shields could be an awful lot of extra work. Forecasting cash flows is something that we covered in corporate finance, and we know how to do that already, but don't forget to add back the non-operating assets to get the total enterprise value. That's it for this session. In the next session, we'll take a look at another alternative method using residual income to value the cash flows that are additional returns on top of the book value of the firm, and some of the accounting issues that come along with that.